Welcome back. You're still tuned into Business Lunch on CNBC-TV18. Now, stocks of Kirloskar Industries as well as Swaraj Engines are surging in trade after M&M said that it would pick up 17.4% stake in Swaraj Engines from Kirloskar Industries. This is for a sum of nearly 300 crore rupees. So what does this mean for all three of these companies? Sonia is here to break that down for us. Sonia.
So let me start with Swaraj Engines, right, because that's the stock that's moving quite a bit. It's up 12% right now. It's hit a 52-week high. As you rightly pointed out, M&M already owns stake in Swaraj Engines, but now it has bought an additional 17.4% stake from Kirloskar Industries for 296 crores. Now, with this, Swaraj Engines becomes a subsidiary of M&M. And hence, M&M gets complete control of Swaraj Engines, which is a big positive for the company. In any case, Swaraj Engines, as we know, was supplying engines to the farm equipment business for M&M, so for the tractors. And the company has done very well in the past. In fact, the revenues were up 15% just in FY22. And the last 3 years, the revenues for the company have improved substantially. Now that M&M will have complete control over the management, etc., it is a big positive for Swaraj Engines. Let's move on to Kirloskar Industries. Now, Kirloskar Industries is the holding company of the Kirloskar Group. They will get 296 crores for selling the 14.7% stake to M&M, and they'll get about 300 crores on a market cap of 1,600 crores. There's also a holding company discount that Kirloskar Industries is trading with. So that's the reason why that stock is up. Now, for M&M has been making all the right noises as far as consolidating their business is concerned. Their focus is on the core business, both auto as well as the farm equipment space, and they're looking to get rid of all their legacy businesses, even unlock more value for shareholders. Now, with this increase in Swaraj Engines stake, it gives M&M more control over the management. They have focused on growing the farm equipment business, not just on the top line, but reinventing the cost structure as well. In the quarter gone by, as per the latest data, they've gained about 1% market share in the farm equipment business. They had the highest domestic volumes of 112,000 units in quarter one, and the volumes itself went up about 18% on a year-on-year basis. Also, M&M is very hopeful about a 7 to 8% compounded growth for the tractor industry over the next 7 years, and they're taking all the right steps in order to not just grow the top line, but also come out with an efficient cost structure. Hence, it's a win-win for all three companies that are, in focus today.
All right, Sonia, thanks so much for all those important details on M&M. But shifting focus to Yes Bank, and take a look at that particular counter, over 3% gain today. But if you really look at 7 days trading action, the stock was much better off earlier in the last week, and definitely had hit a 52-week high when a lot of deals got announced. So the full resolution is what we are looking at. So CNBC-TV18's news break on this particular counter has been confirmed as Yes Bank perks up in trade after its board has cleared the sale of 48,000 crore rupees worth of weak assets to JC Flowers ARC. Ritu tells us more about this deal.
That's right. As we reported earlier, Yes Bank has now said that it received no challenger bids to the 11,183 crore rupee offer made by JC Flowers ARC to acquire its 48,000 crore rupee NPA portfolio. And therefore, in its meeting on the 20th of September, the board of Yes Bank has approved the declaration of JC Flowers ARC as the winning bidder. And separately, they've also approved the acquisition of up to 19.99% stake of Yes Bank into JC Flowers ARC in single or multiple tranches. But importantly, this acquisition of stake in the ARC is going to be subject to regulatory, specifically RBI approvals. So we'll have to see how that pans out. However, for the transfer of the NPA to the ARC, no other regulatory approvals are required. So this paves the way for cleaning up of Yes Bank's balance sheet. In another important development, Yes Bank said that the Reserve Bank of India has approved the appointment of R. Gandhi as the chairman of Yes Bank for a period of 3 years. Remember, R. Gandhi, who was a former RBI deputy governor, was also on the board of Yes Bank for 2 years during the period of reconstruction of the bank. And now, with the newly appointed 9-member board, R. Gandhi is set to take over as the chairman for the next 3 years.
All right, Ritu, thanks a lot for getting us all of the details on Yes Bank. But another stock we're focusing on today is Central Bank of India. That one is surging after the Reserve Bank removed the bank from the prompt corrective action framework, which will now allow the bank to open more branches and also grow the loan book faster. So earlier today, we spoke with MV Rao, who is MD and CEO of Central Bank of India, and he says that the bank's asset quality is set to drastically improve this year. Listen in.
we will be coming out of the PCA because the measures what we have taken. And we know that it is only a matter of time, and also the confidence what regulator will be getting on our activities. That's why we have factored all these things when we have given these projections. I tell you, our gross NPA will be drastically coming down. Slippages, what we are envisioning for the quarter of September will be around 1, not more than that. We have given the graded gliding path where from 3.93 we will be touching around 3.6, 3.55. In that range we have given.
All right, moving on then. After 3 successive months of inflows into India, well, Credit Suisse has studied the source of funds into the country, and the main takeaway is that India remains vulnerable if there is a global scare over emerging markets. In fact, Lata Venkatesh is here with the key findings of the Credit Suisse report. Lata.
Well, it's interesting, but that is the big and perhaps difficult takeaway for us, that the India dedicated funds, of all the funds that flow into India, the India dedicated funds account for only 13%, the balance 87% come through global and emerging market funds or sovereign wealth funds, which again distribute globally. Now, there's fresh, the problem therefore is that if there is a concern over emerging markets because of, say, Fed tightening, then we could lose, even if it is not our fault. Let me give you other details that Credit Suisse has put out. They say mutual funds and hedge funds accounted for 3/4 of the outflow that happened, if you remember, from September to June, those 9 months of outflows. And in the inflows, mutual funds were the ones who bought back most of it in the last 3 months. Sovereign wealth funds have been more sedate. They have bought all through those 9 months when everyone was running away from India, and their total share in FPI, total portfolio funds, has gone up from 12% in 2017 to 16% now. So that's a positive for India funds. They have separately, Credit Suisse has studied 6,300 funds, which account for about 70% of the total mutual fund hedge fund flows into India. And this is that breakup. So this is not the breakup of the entire universe of funds, but the 6,300 funds which account for 70% of the flows. They say 13% only came from India dedicated funds, as we just said. Emerging market funds brought in 47%. Global funds, through global funds come another 31%, and another 9% comes through Asia funds. Now, Credit Suisse also says that active emerging market funds accounted for half the FII selling in those 9 months, September to June. Emerging market funds, actually, their overweight over India has gone down. They were at about 60% overweight in 2017. Even now they're overweight, but they're only 9% overweight. And the fall in overweight is because India's weight itself has increased. It's also because of new listings, higher free float in some stocks. And as I said, outperforms, therefore India itself the weight has increased. Another list of important takeaways: 1/3 of the FII holdings are coming through sovereign wealth funds, pension funds. That is our positive, because they are more sedate. They don't go in and out like mutual funds. But that is only 31%, 1/3. For the remaining, we remain vulnerable to what global funds think about emerging markets. If they think that because of the Fed tightening there will be outflows, then there can be outflows. But the vulnerable pocket is really financials. Credit Suisse, however, is positive on financials because that sector is undervalued, they say, and there is a possibility of earnings upgrades.
All right, Lata, thanks a lot for getting us all of the highlights of this very interesting note from Credit Suisse. With that, we're going to get into another short break now. But when we come back, we bring you the latest from the Russia-Ukraine war as Russian President Vladimir Putin calls for mobilization of troops once again in his address.